rising acceptance of digital assets in financial portfolios. Investing is a tricky business, investing in digital assets more so. Just like with any financial asset, investing in digital assets comes with its own set of reasons whether one should invest in them or not. Outside of these things like personal appetite for risk and knowledge of the space, let's look at the pros and cons, the risks and rewards of investing in digital financial assets. Cryptocurrencies are finding acceptance as an asset class by themselves because of the view that enough institutional investors are investing in them. Cryptocurrencies, especially popular ones such as Bitcoin, have in recent years seen institutional investors gravitating towards them to help diversify their existing portfolios. But if the infamous 2008 global financial crisis has shown us anything, it is that institutional endorsement does not guarantee that an asset is a genuine and sustainable store of value. Subprime mortgages and structured credit products were widely adopted by a range of institutional investors across geographies. But they were derailed and lost traction as a credible investment asset when many subprime borrowers defaulted. So while institutional investment is a good indicator, it is not an absolute standard for the validation of an asset class. The scarcity of cryptocurrencies, like gold, might seem like it makes a natural hedge against inflation. There is some truth to this observation. The total bitcoins that will ever be mined is capped at 21 million. It has a quantifiable limit on its availability. There is also behavioral evidence that cryptocurrencies do behave like gold when reacting to various macroeconomic developments and changes. But that is where the similarities between gold and cryptocurrencies pretty much end. There are some notable and key differences that set gold apart from cryptocurrencies. Gold is a physical asset, meaning it is tangible, can survive harsh conditions, can be transported from one place to another, and whose existence can be physically verified. Cryptocurrencies, on the other hand, exist only in the digital sphere and come with technological risks that aren't fully understood, simply because they are still very new and evolving. Technological advances that can break blockchains will end the existence of cryptocurrencies as we know them today. And as dramatic as that may sound, such technology is plausible, if not imminently probable. In an interview in 2021, Guido, the CEO of Trail of Bits, a software security service R&D firm specializing in blockchain security, pointed out that the adversarial attacks on blockchains, programming bugs and vulnerabilities, and a sudden drop in mining power due to the energy crisis is just some of the risks that could derail crypto blockchains. Gold also finds actual economic utility as a commodity. It is used in jewelry, electronics, and other industrial applications. Demand from jewelry often supports gold prices when investment demand is weak. Cryptocurrencies, on the other hand, do not enjoy any such economic utility yet. They could derive utility if they come to be widely used in, say, international payment transfers. However, we haven't seen this happening as of now. Gold enjoys universal acceptance with a much wider investor base, including very large investors such as central banks. And cryptocurrencies continue to battle legal uncertainties in many countries. Gold takes the upper hand, at least as of the current market scenario and acceptance of cryptocurrencies. An argument made in favor of cryptocurrencies is that it enhances portfolio returns quite significantly. A research note by Goldman Sachs, published in 2021, does show that an allocation to cryptocurrencies does enhance returns. The scarcity of cryptocurrencies, their undeniable ability to diversify portfolios, and their increasing acceptance among investors continue to be a big positive supporting factor. But one must note that the returns from cryptocurrencies remain highly volatile and could hurt portfolio performance in the event of a sustained downturn in crypto valuations. Disruptive technological risks and legal risks ought to temper the enthusiasm. Their ability to diversify portfolios also came into question in 2020 when the value of Bitcoin fell by 50% at the same time as US equities lost about a third of their value when the COVID-19 pandemic hit. A strong argument for long-term investability in cryptocurrencies has been pointing towards increasing investor interest and trading volumes. This, many believe, has made cryptocurrency markets deep and liquid. There has been definite broad-based interest in the top 3 to 4 cryptocurrencies, with trading volumes rapidly increasing over the past few years. Although returns have been volatile, there have been not many instances when market liquidity has posed significant challenges to trading in cryptocurrencies. But if we look beyond the last few years and say look at the last 15 years, it has taught us that even the most well-developed of markets can suffer from bouts of extreme illiquidity and price dislocation. The crisis in 2008 severely dented market liquidity in many financial markets that were otherwise liquid. More recently, following the COVID pandemic, prices of crude oil futures, one of the most liquid and widely traded commodities, got severely dislocated, trading negative. And this was considered pretty much impossible until it happened. Digital asset investments are still in their nascent stages by all counts. They are exciting for sure in the eyes of modern-day investors, but they need to be dealt with equal caution. An acute understanding of the fundamentals of investing in digital assets is needed before one braves it and takes the plunge.
Want more information? Visit us at www.herowired.com.